In this video, we're going to talk about the reverse triangular merger, which is a type A tax-free reorganization. So let's say that you're the director of a corporation called Amazing Animals that runs retirement homes for animals, and you decide that you want to acquire another firm called Turtles and Things that runs retirement homes specifically for turtles and snakes and so forth. So you want to acquire this company, but maybe they have a lot of liabilities or contingent liabilities that you don't want any part of. You don't want them to be part of your organization. So what you do is you say, okay, well, I've got an idea. You've got a subsidiary. So you've got a subsidiary, and this is a subsidiary of Amazing Animals. Let's say that the subsidiary is called Animal Heaven. So you have the subsidiary, and you can create the subsidiary, or if it's an existing subsidiary, doesn't matter. You have this subsidiary, and what you're going to do is you're going to acquire Turtles and Things. That is, Amazing Animals is the purchaser, Turtles and Things is the target. However, it's not just going to be like a regular type A merger where Turtles and Things merges directly into Amazing Animals. Instead, how it's going to work is actually the subsidiary, which again is a subsidiary of Amazing Animals, is actually going to merge into Turtles and Things, right? So the subsidiary of Amazing Animals, this Animal Heaven, is going to merge into Turtles and Things. Okay, so again, now even though it's taking place this way, and this is why it's called a triangular merger, if you see here the triangle shape, still it's going to be the case that Amazing Animals is still the purchasing corporation. They're still the purchaser, and Turtles and Things are the target. And what it is so now ultimately this subsidiary is going to disappear because it's merging into Turtles and Things. And so the subsidiary is going to disappear, and then you'll just have this company and then this company. And so basically the liabilities, any kind of unknown liabilities or whatever, would remain with Turtles and Things, and they wouldn't become part of Amazing Animals. So if you were to do, for example, a just regular type A merger where Turtles and Things went directly into Amazing Animals and Amazing Animals got stuck with any liabilities. So let me give you a quick little rundown of some of the requirements for a reverse triangular merger. Now, so number one is that basically if this would have qualified as a type A merger, had Turtles and Things merged directly into Amazing Animals, then you're okay on that requirement. So basically all the things that you can think about with a regular type A merger are going to apply, although there are a couple of additional things. So one is that the purchaser, in this case, again, remember the purchaser is Amazing Animals, must acquire substantially all of the target's assets. And you say, well, what does that mean? It means a little something. If you've already watched a video on forward triangular, they have that same requirement, but it means a little something different with the reverse triangular merger. So what it means with a reverse triangular merger is essentially two things. So after the merger is complete, after the subsidiary has been merged into Turtles and Things, the target, which is Turtles and Things, must hold substantially all of its own properties, right? So all of its own properties it must still have after the merger. And if we were to look at jointly the target and the subsidiaries properties, Turtles and Things after the merger must hold substantially all of the assets of both of them, right? And so that's a little bit different than with the forward triangular merger. Now, in addition, this is a big difference between just a regular type A merger or a forward triangular, is that with a reverse triangular, at least 80% of the consideration being given, and again, it's the purchaser who is ultimately giving consideration and so forth. So at least 80% of that consideration must be voting stock of the purchaser. If you remember with just a regular type A merger, it would be at least 40%. Would have to be stock from the purchaser, in this case Amazing Animals. But with this reverse triangular merger, it has to be at least 80% of the consideration. And that's, again, the consideration is what Amazing Animals is ultimately being given to the target in exchange for the deal to go through. So at least 80% of that has to be voting stock from Amazing Animals. So again, these triangular mergers, whether it be forward triangular or reverse triangular, they become real popular because, again, any unknown liabilities or anything with the target are not going to become part of the purchaser, right? And in this case, since the subsidiary is merging directly into the target and the subsidiary ceases to exist, so basically Turtle and Things is just going to retain those liabilities, and they're not going to be transferred to Amazing Animals.